I think it just reinforces that theme that we've seen for the last 18 months, and that is job growth continues to accelerate. And before the break, I think I heard you say that it's diversified. It's just not minimum wage jobs. We're seeing it all throughout industry and even in higher paying jobs. Obviously, except for the mining industry, it is, and it's just telling us that this recovery in the U.S. is for real, and jobs continue to be very robust.
Obviously, this JOLTS report follows that official data last Friday. Is the strength, though, of the labour market, in your opinion, a little bit misleading, though? Because as we've been talking about, I mean, a lot of those high-paying jobs, they're now being replaced with more of those low-paying jobs and, I guess, essentially plugging that hole. Do you think we need to be careful, I guess, about making that direct link between the labour market and the broader economy?
Yeah, we could overthink it. You're exactly right. And for years, I believe the unemployment rate was higher than was published because a lot of these were people just taking temporary jobs or being underemployed, et cetera. But on the other side of that, we have to remember that, or not remember, we have to think that the housing market still has a long way to go for recovery. It continues to recover. With that, anything that has to do with the building industry, home building industry, there's still a lot of demand left to be had, as it were, as we continue to rally back to where we were.
Larry, it's Paul Bloxham here. So the labour market looks as though it is showing signs of continuing to improve, but of course markets are very volatile, global conditions are weaker. What do you think Janet Yellen's going to tell us this week, later this week? Do you think she's going to be very focused on that domestic labour market story, or do you think she's going to be a little bit more dovish and focused on the global weakness? Which side of the fence are you on?
Paul, that's a great question. I do think she's going to cover that because there's so many misnomers and so many hidden doors with regards to the workforce in the U.S. and the way it's published. Inflation will be something that's also very magical, mysterious. People don't really understand what they read. But I think she's going to say that she's going to remain data dependent. It's going to be very dovish. I think she's going to rule out March, take it off the table, and I think that's what we're seeing today. That's not necessarily a tailwind, as you would know. I think she's going to answer questions about reintroducing zero interest rate policy, quantitative easing, negative rates, all those sorts of things. But at the end of the day, I think it's going to be a very dovish talk. Fully acknowledging that the 4 rate hikes that they were predicting is probably not going to happen, perhaps closer to 2.
So what do you think the dots are going to look like in March, Larry?
I think the job creation and the rate is going to be about the same. I mean, I think especially when it comes to the housing sector, it's not just people who build homes, but as you know, just all the ancillary businesses. There's still a lot of growth in that area. Financial services are doing terribly, as we know, but on the other side of that, we're seeing a big boom in the housing market, also some consumer discretionary. So I do think it's diversified enough that we'll continue to see growth throughout in March.
But so when we get the dots from the FOMC in March, are you thinking that they're still going to have 4 hikes in them, or 2, or what would be your view?
Yeah, Paul, my view is that they're going to have to meet the market at some point. As you know, the market expectations are well beneath the FOMC's current dots. And I think slowly but surely they're going to have to meet along the line. I'm of the mind that it's not out of the question to see 3 rate hikes this year. It sounds ridiculous to say, but I do believe that could still happen. And I think the FOMC is slowly but surely between now and March going to meet the market slowly for the expectations of the dot forecast.
We know the Fed usually says, they don't look so much at those asset prices, but hard to imagine that they, wouldn't take into account the recent moves we're seeing. What are your thoughts on these moves, Larry? I mean, some saying that at the moment we're just seeing a bit of a setback and this is actually providing a good buying opportunity, but others saying that really it's actually indicating more of a slowdown in the months ahead. Which camp do you sit in?
I'm wary of stocks right now. I really am, given the price action we've seen. But my eye is on, or the risk I see is actually to the upside. And there's so many things that could change that. we have to recognize the fact that the fourth quarter earnings have marked 3 quarters in a row of earnings going down. So people talk about recession. Corporate America has been in a recession for a while. But I do think there is room for a surprise because there's so much negativity out there right now. And you have, Yellen speaking tomorrow. You have Draghi speaking next week on the 15th. And then we have Plaza Accord II on the 26th, not to mention China coming back from holiday. They've been very aggressive with their stimulus, as you know, and there could also be any kind of scare or surprise in the oil with an oil accord of some sort. So I'm never out of stocks. I mean, you know that. And I still believe Japan and European equities are favored over the U.S. I look terrible right now, but I still maintain my stance. Nothing really has changed.
All right, I wanted to ask you about some of the other moves. One of the big ones at the moment, gold. Really, it's been enjoying a pretty nice sort of rally, strong start to 2016, I guess. Really trying to make sense, I suppose, of these moves that we're seeing at the moment. Clearly, everything seems to be going right for gold at the moment. Has it been too little or too much? What's your view on the moves that we've been seeing?
Yeah, I guess we'll see, but it's funny because on the American press, they're all saying gold's rallied is a signal of confusion, and I don't think it's confusion at all. I mean, keep in mind that the U.S. dollar has dropped by almost 3% from the beginning of the year. Look at the 2-year rate. Look at 10-year tips. The Treasury inflation-protected yield curve. Yields are down, so it makes sense. And you also have a big influx and a big amount of demand from China that was underestimated by a long shot. So I could definitely see gold continuing. It's going to be very interesting to see. I think a lot of it just linked to what happens with the U.S. dollar and the Treasury market.